So average age of receivables. The average age of receivables is equals to 365 days because in a year there are 365 days. We divide by the accounts receivable turnover, which we computed a while ago. So if, for example, you have 35.3 times, then you will have average age of receivables of 14.4 days. Okay, so average age of receivables provides a rough approximation of average time that it takes to collect receivables. Now, what is inventory turnover? Inventory turnover, when your cost of goods sold class is the cost of the items already sold out. But then it is the measure of inventory turnover is a measure of the number of times an entity sold its average level of inventory during the period. So, kapila mahali, no? Okay, mabaligya. Ma-replenish yung inventories. Right? So, inventory turnover is the cost of goods sold divided by average merchandise inventory. Average merchandise inventory can be calculated through your beginning inventory, last ending inventory. You divide by 2. And then your cost of goods sold will be the cost coming from the items that were sold during the year. So, for example, 1 million ang cost sa imong product. Although tagbaliga nimo siya ng 2 million, example ra. And pero an actual cost dito na involved sa product is only 1 million. And then an inventory left sa imo warehouse from the beginning and ending measure. The lesser it is that inventory left in your warehouse, of course, that means the faster, no? The faster si Jama baligya. Kay nawaya malazon siya sa imo warehouse. So that's 9.99 times. Example for that. Okay? So it's a measure of the number of times the entity sold its average level of inventory during the period. So the more it is sold, the better, right? Kay paspas ang pag-stocking nimo sa imong goods. So the average age of inventory is computed by 365 days over the inventory turnover. So for example, your inventory turnover calculated was 9.99. You divide it by 365 days. That means you are replenishing your stocks every 37 days. So average age of inventory provides a rough measure of the length of time it takes you to acquire or sell and replace the inventory in your warehouse or in your store. Right, so what are profitability ratios? This one is different na subclass. That was liquidity. This time it's profitability. Liquidity is more cash to pay, more assets to pay easily, your liabilities, and you have enough money, you have more cash class. While profitability means income, earnings. Okay, so mas nikita ba ang business? It could be man good na you nakita ka but pa na cash. Okay, profitability ratios are a type of accounting ratio that helps in determining the financial performance of business at the end of an accounting period. Profitability ratio shows how well a company is able to make profits from its operation. Okay, whether nikita pa siya and how, okay? So we have this return on total assets. It's a measurement also. It's a ratio also that will tell that how much return you will get from your total assets. So that is profit plus interest expense over average total assets, or profit plus interest expense over your total assets, that is beginning of the year plus your end of the year divided by 2. It's your average total assets. So you can get the figure coming if you will have a competition. If your net income or your profit is 17,575, and then you have also an interest expense of 3,120,000 paid, you just have it added back together. That means your income over your average total assets. That is the measurement. Return on total asset measure of management's efficiency in using its asset to earn profit. So how well did you use your asset? Did your management use your asset properly? If the higher the return, the better, right? Because the more they fully utilize the assets there. So, example, you have buildings, you have land, you have resources, and then your return of assets is high, then you are fully utilizing these assets to to make sure these assets will earn, right? But if waya, less ang imo return over the asset minimum nimo tag gamit ng tarong. Okay, so that means poor management. The more you earn, the better. Okay, return on ordinary equity. Return on ordinary equity means profit minus preference dividends. Okay, and no, profit minus preferred shares in a preference. Profit minus preferred shares or preference divided by dividends. But dividends are those that are declared, no, at the end of the year sa ila shares divide. So pilaan tagbalik sa ila. Okay? Pilaan na balik sa ila over sa declared dividends. No, average ordinary equity. Oh, I think mali message. Sorry, class. Profit minus preference dividends over average ordinary equity. Amo ni siya. Okay, return on equity gani is income. Return is always you have to think of income or profit over ordinary equity. Kung pila ang ordinary equity shares. Preferred dividends meaning siya declared dividends sa preferred. Okay, sa preferred class of a specific, okay, in a equity class only happens sa corporation. So when there's a preferred share holder, they usually get dividends that preferred share will get. So if the profit is already there minus the preferred shares, that preferred dividends declared, that is what is left, right? That is what is left from the profit after the declared dividends to the preferred shares. So what is left is to the ordinary equity owners, the average ordinary equity. So because you know there's an ordinary and there's a preferred. When the preferred already takes out that share or the dividend from the profit, that means what is left is from to the ordinary rakan. So sorry class for the slides, for the owner of the slides, you can edit this so that it will look presentable. You can always divide that over the average ordinary equity in order to get what is the return on ordinary equity. Here, the sample, it shows 18.45%. So those that have invested ordinary shares actually are getting a return of about 18.45% from their investment. So return on ordinary equity shows the relationship between profit and ordinary shareholders' investment in the entity. Okay, so that's why preferred dividends were taken out because normally class sa corporation, after all if nakuha na ang parts of preferred, then that's the part of the ordinary. And that the ordinary will get only this much coming from that profit. So that's the measurement on return on ordinary equity. Okay, so basic earnings per ordinary share. Profit less the preference dividends over the average number of ordinary shares outstanding. So the calculated we calculated return on ordinary equity. That's the income over ordinary equity. Here is the earnings per ordinary share. So tag measure per share, no? That one is tag measure ordinary shares. This one is per share. So the same profit minus preference dividends, but then here it's calculated ang average number of ordinary shares outstanding. That is beginning plus ending divided by 2. Then you can get your basic earnings per ordinary share, which is a measure of the profit earned on each ordinary share. So profit minus earnings ratio is equals to market price per ordinary share over basic earnings per ordinary share. So it's different subclass, no? So market price per ordinary share. Kung nagpila ang market presyo sa ato na shares, taga isa ka ordinary share over the basic earnings sa ato na ordinary share. That is the profit to earnings ratio. So price earnings ratio indicates the degree to which investors value an entity. Okay, the more profit earnings, the better. Okay, dividend yield. Okay, dividend yield is when cash dividends per ordinary share is over market price per ordinary share. So for example here, there are 10 million shares and there's an 8,000 dividends declared, and then the market price per ordinary share is 27 pesos. That means 2.96% is the dividends yield. Dividend yield is the ratio of dividends per share to the share's market price. This ratio measures the percentage of the share's market value that is returned annually as dividends. So of course, class, if you're an investor, you want to know how much yield you will get, dividends you will get. So this is wrong spelling with the dividends should be with a D, right? Okay. Solvency ratio. Solvency ratio, I already told you that ability to pay liabilities. Okay, long term. Solvency ratio measure the ability of entity to survive over a long period of time. Long-term creditors and shareholders are interested in the long-run solvency. So particularly its ability to pay its interest as it comes due and to repay the principal of debt at maturity. So time interest earned ratio, this is one of the ratios for the solvency ratios, or the TIE, times interest earned ratio. Profit before interest expense and income taxes over the annual interest expense. So for example here, profit is 17,575,000 plus 3,320,000 plus 9,400, 9,463,462. Divide by 3,120,000 interest expense. So, okay, that means you have 9.7 times your interest, times interest earned ratio. So times interest earned ratio is a measure of how readily an entity can meet interest payments with profit earned from operation. So it will tell you, or the bank can tell how by this, if you have, that's why when the bank asks for financial statement when you want to get a loan, because they know how many times you can pay from your operations. The more money you can earn from your business, the more secure the bank will feel. For example, you loan from the bank and you will have interest. This will be their measurement, how many times you can pay actually. Debt to total assets ratio, it's total liabilities over total assets. That means, pilain mo total utang over sa mo total na assets. So, from example, there's 40%. So, your utang is only 40% from your assets. You're very capable enough to pay your liabilities in case magkauno-uno. So, debt to total asset ratio or debt ratio shows the percentage of the entity's assets financed by debt. Equity to total assets ratio. Total equity over total assets. Total assets, remember, is equals to liabilities plus equity, right? That means if you compute for total equity, equity is almost equal to total assets if you have less liability. But here, what is formula is total equity over total assets. So for example, 103,550,000 over 172 million over 172,583,000. Your equity is only 60% from your total assets. That means your liability is 40%, your equity is 60%. So this ratio shows the percentage of the firm's assets financed by shareholders. So this is the equity portion of the business. So the assets is actually financed by two, equity and liabilities. Remember, a while ago we computed 40% liabilities. So now the equity portion of the business or the total assets is 60% coming from shareholders. So thank you, class, for listening. Let's stop the video now and hope to see you again.